And I appreciate the time here. I'm not sure the uptick rule would have done anything to stave this off at all. In terms of the studies I've seen, and I understand the SEC is still going to take the balance of the week to give us the triggering event, and I know that they're sorting through 40 different market participants, market centers here, in order to try to glean that information. But in the meantime, let me make some observations, and one is that I think if you ask the average American investor what's important, he'd say, an orderly, well-functioning trading environment. I think she or he would say that there's a little bit of apprehension in terms of what has happened in the past in the market. And I'm going to go back to October of 2002 when Bear Stearns sent an order to sell $4 billion in stocks in the Standard & Poor's 500 stock index. They had meant to send that order they'd meant to send an order for $4 million, not $4 billion. And fortunately at the time, the New York Stock Exchange specialists saw that, and they sent that information back to the Bear Stearns floor brokers. After all, this was a time when we had specialists handling and slowing down a lot of these problems. But they didn't get it handled before $622 million in stock had been sold instead of $4 million. So that gives us a window back into what's happened in the past, where I think investors first began to get spooked about what could happen in the market. And back then, of course, we only had two dominant centers. We had the New York Stock Exchange, we had NASDAQ. Now the SEC is looking at 40 different market centers. So, I think as we go forward, we can look at some of the upsides that we've seen. The bid-ask spreads have been reduced by the fact that everything's sped up in the market. In some ways, the market's more efficient. But we know that Germany and other countries have looked at ways to look at individual stocks and put a real-time circuit breaker in effect, where if those stocks drop more than 5%, you're going to have a hold. In 5 minutes, you're going to have a hold after that on transactions as regulators and as market participants focus on what's afoot in case we've got something like the Bear Stearns errant order back in 2002. As we move forward, I think we recognize that our markets now react in milliseconds to events, but they are monitored by humans who respond in minutes. And in those minutes, you can have the loss of billions of dollars of damage. Let me also say that I don't think the members here are criticizing the SEC for over-regulating. I think we want the SEC to regulate. I think my concern has been that the market knowledge and experience is greatly lacking at the agency. As myself and my colleague have said in the past, it's over-lawyered at the SEC. We had the observations during the Bernie Madoff and the Alan Stanford Ponzi scheme cases where we heard from Mr. Markopoulos about those problems at the SEC. And we're hoping that culture can be changed as the SEC looks into this particular problem as well, and re-engineering the oversight and perhaps putting into effect better circuit breakers to handle this problem. Thank you, Mr. Chairman.